it's not, there are stock-specific or company-specific high performers. I mean, look at Trent. That was a great performance. Bata was not bad. Yeah. So, you know, overall, what were the consumer numbers for December? They were bad. Minus 3.7 on FMCGs. Non-durable consumer goods, you know, contracting by 3.7. And yet you had a Trent, yet you had a, you know, Starbucks within Tata Global. So, I mean, I'm just persisting with the mid-cap questions. Andrew.
Yeah. I mean, in terms of, you're asking me whether I should be dipping down to mid caps. You know, no. It's tempting, Lata, but you know, if things are you know, delayed, then I'm afraid that you'll have to reverse all of the gains that you've had in small and mid caps.
No, I take your point. I'm equally skeptical, like I told you, especially after the conversation with the state finance ministers. Yes, consumption does have a problem. What about the two sectors that we didn't discuss? IT, the NASSCOM survey sounds pretty positive on, at least stable to positive for the next year. And pharma.
So pharma, we became more constructive about 6 months ago, and we think the sector is obviously still has a few problems there, but we think it's all in the price now. So I think we would look to be adding pharma, but again, you have to be cognizant of what's happening globally at the moment. To that to play through, but we're out more constructive. On IT, kind of probably more neutral. There's obviously it's a place to hide when markets are more volatile, but there's nothing that excites me to kind of say I've got to go into large cap IT. If anything, there might be some more interesting stories at the kind of mid and in the mid cap stories there, but that's something that we're looking at more.
Okay. See, I made you say mid caps at least at the end of the conversation. All right. Point taken, Andrew. Your caution is very well taken on board. Thank you very much indeed for joining us with your thoughts. In rara times, it's important to hear such voices.
Yeah. Just a point. I think Nimesh sent this note. Mahanagar Gas and IGL. There's a City note. There's a bit of a pressure that these stocks have seen at higher levels. And there's an open access regulation could impact City Gas stocks. That's the point that they're saying. It could be as high as...
Open access, sorry.
So trying to understand more, what that means. But it's saying that, 13 to 14% profit impact is possible, which the market is not pricing in right now. So both on IGL and MGL. So that's City, that's a Credit Suisse report that, Nimesh has sent. So we'll try to get more details. I think we'll check more on probability. Yeah. But there's a bit of a risk on a couple of
maybe we can have Nimesh himself come and explain that report. Open access, that means Mahanagar doesn't have monopoly over Mumbai and others can access in terms of suppliers. I don't know what it means. I really don't know what it means. Haven't read the report. But there is a Credit Suisse note which has put IGL and MGL
and
under
both of these
pressure.
are trading at, the high. They've both had a big rally, of course. So that's why perhaps there's some kind of selling pressure that you're seeing on both these names today. Okay,
so that's what the first sentence says. I'll read out the report to you. Open access regulations could impact City Gas stocks as one. Network tariff is low, based on a 14% ROE. New players lead low capex as given access to last mile connectivity. I mean, last mile connectivity is already a given. And CNG stations are out of infrastructure exclusivity. New players can set up infrastructure in non-covered areas with first right to expand with existing players. So basically competition. Others can come into otherwise monopoly areas seems to be what they are hinting at. We'll discuss this a little later in the show. For the moment, we are back to results analysis. And there are very few companies that have reported extraordinary good performance. One such company is Cochin Shipyard. I mean, numbers are good, really good. Revenue up 25%, EBITDA up 25.4%, margins have expanded a bit, and net profit as well up 30%, 32% actually. And not on the strength of other income, though other income is just up about 8%. Madhu Nair, Chairman Managing Director, Cochin Shipyard, joins us now. Good morning, Mr. Nair. Thank you very much for joining us. This is very good numbers. What went right? And can it continue to look good for the current quarter as well?
See, we have signed the phase 3 contract of the aircraft carrier. And in fact, last few quarters, we were not able to recognize full revenues on what we were doing on the aircraft carrier. But now the contracts are in place. See, the work was happening earlier also, but we couldn't really get in the revenues recorded. So now the contract is in place, and the phase 3 contract of the IAC is delivering. So it's looking good. On the PAT, you're well aware that we opted for the lower tax regime. So between the PBT and the PAT, that extraordinary PAT increase is because of the advantage we are getting from the lower tax slabs also.
Okay. Mr. Nair, good morning. So in terms of your guidance, both for shipbuilding and ship repair revenues, if you are upping it or lowering it, if you could give us more information?
I've generally been guiding around 12% growth, but I should say around 14 to 15%. This is where we will grow, and it looks good. Ship repair this particular year, as compared to last year, right at the start itself, we had lowered our figures because last time there was a one-off aircraft carrier repair which we are handling. This time it is not there. So what we have projected around 600 and odd crores will come in from ship repair, and we are happy with that, because it's adequately compensated by ship building, and that too coming from the aircraft carrier phase 3 part.
Okay. Well, actually, in your last conference call, you did mention 15% growth for FY20. So, I want to know more about this order that you are able to now recognize, the air carrier order. How much is that as a part of your total order book? And how much can we expect in terms of recognition? The same chunky recognition in every quarter?
See, as we move forward, next few quarters, we'll see significant part of the aircraft carrier coming in, because the aircraft carrier is currently in very advanced stages, and we expect to take her out for sea trials very shortly. And so we are getting into very advanced stages, and we should be able to realize revenues from the aircraft carrier. So I can confidently say that the next few quarters we'll see quite some traction coming in from this.
How much is that order?
The phase 3 alone is around, altogether the aircraft carrier was a big project, and out of which the phase 3, there is actually a phase 3 part, and there is a material portion in it. The phase 3 alone is around 3,200 plus.
Okay.
I can't give you the exact figure, but it's 3,200
Fair point.
plus. Yeah.
Fair point. Will there be any improvement? I mean, you've maintained your margins at about 22%. Is there a chance to do better?
More or no. I think we are already at a fairly high levels of operating margins here, and this is coming from the mix of ship repair and shipbuilding we are doing. So I would be extremely happy to hold it at this point, because what we are doing is very good. This is what I feel.
No, I mean, no taking away. 22% is a margin people will give an arm and a leg for. I take your point.
Correct.
Any visibility on order book, your L1 and something, or some orders in the market that you are bidding for? How does the FY21 order book look?
Not yet, but I can say that there are at least 6 bids towards the Navy and the Coast Guard which we have put in, and I can say for sure that we are going aggressive on this.
Okay, well, good to hear that, Mr. Nair. Pleasure speaking with you. Thank you very much indeed for joining us with all those details.
Thank you.
So that's Cochin Shipyard guiding for at least a 15% growth and maintaining the 22% margins and a good order book. Can we just take a look at the past 3 years' numbers, the consolidated numbers of first the operating profit? Okay, we are starting with the total operating profit. That's a fairly good climb in FY19 as well, and then I guess you'll have the margin picture, and then clearly, as the chairman said, they have done well in FY20 because they are now going at 22% margin, so that's a distinct improvement. And then you'll have the earnings per share as well. That's declined a bit, but 28 is no laughing number.
Yes, the market, by the way, and that's the point. Today's pre-open, even the actual opening, looked like a bit of a bit of a trap because the market closed at the highest point yesterday. It's seen a lot of buying. And if after 2 days of back-to-back rally of buying, this will resolve itself on the upside at some point. And the Bank Nifty is clearly showing you signs that it needs some kind of trigger to cross that 31,500. That I think is still perhaps a bit off. I'll just pull out United Spirits once again. That's now crossing 700. It was one of the stocks that we discussed, Lata, in top 10. There it is, as we speak, now moving higher, so at the high point of the morning.
Well, fundamentally, as a person who has seen several cycles in banking, I can tell you this commercial real estate munificence they have got is huge. It is as bad or as loose as the 2009, restructuring policy that we adopted in the face of Lehman. It's big. We don't even have a Lehman. So, I mean, and there are no one buying houses. You're giving a munificence to a sector where demand is lacking. The answer really is to pull down prices, perhaps, so that people can afford. But, I mean, any more further looseness in commercial real estate or any further looseness for banks, you're restructuring MSMEs, you're allowing a somewhat restructuring in commercial real estate. Anything more is scary. I hope the trigger that you're talking about does not come from looser rules. May it come from growth. May it come from, some other quarter. But yes, at the moment, the Bank Nifty could do with a little bit of help. At the moment, that's the one that's dragging a little more than the Nifty.
Torrent Power, by the way.
Oh, yes.
Those are good numbers,
Solid
and the
performance.
market is rewarding that. So look, this is a market which has really been very mature in terms of rewarding good earnings. 7% higher now on that stock. Though, if you see the futures plate on Torrent Power, that's up only 5%. And there's a big discount which is prevailing there. I don't think this is going to be a dividend component of 11 rupees on Torrent Power. But if you just quickly pull out the futures plate on Torrent Power, the 10 rupee discount which is there on that, and the open interest build up of about 20%. I don't know what to make of that. I'll try to get some more information on that, but very aggressive turnover in futures, about almost 200 crores, 19% open interest build up. Spot is up 7%, future is up only 5%. Then it's a 3% negative cost of carry that you're talking about. That's a bit of a mystery to me, but I'll try to find out more of that.
All right. Okay, Anuj has some letter writing and SMSing to do, I guess, to find out what's happening. For the moment, we will take a break and give him that time. We are also going to continue with corporate earnings analysis. Manish Gulati, the executive director, of HEG, is going to join in to decode their third quarter numbers.